There's more optimism in the markets today than there has been in 2 years in the cattle markets. Market psychology goes a long ways. Psychology of what people are thinking makes markets move in different directions. And one of the things, there's kind of some things out there that reason to be optimistic, and there's some things out there that you're a little bit gun shy to just jump on the bullish wagon all the way. And there's things politically, and the global impacts today are much more so than they've ever been in history regarding which way the markets can swing. And so what I wanted to talk about today is how we kind of navigate these cycles and the big roller coaster that we're constantly on as producers. So again, how's this deal going to go? And those of you that have sold some calves maybe this spring, gotten really good prices. Those of you that were thinking about maybe having to sell calves last October, it was horrible, wasn't it? The U.S. average price last October was $127 for a 5.5-week calf. How many of you were forced into selling some? I mean, not everybody's set up to where they can retain ownership. Those that did retain ownership for a period of time after that, it benefited you greatly. But some people just simply don't have the labor, the feed, the facilities, what have you, to retain ownership. You are forced to sell in your calves during the month of October if that's when you wean them. Well, that was a horrible experience for a lot of people. We want to try to guard against those types of things, but we also have to plan on those types of things always being a possibility. And I'm sure Salem this afternoon will talk to you, navigating the hurricane, if you will, and we know that those can happen. So what I wanted to talk to you about is, the cattle cycle price, the price cycle is alive and well. In other words, we look at this and we go back to, the mid-1970s, if you will. And what it shows is that about every 10 to 12 years, you go from a cycle high to a cycle high or a low to a low. About every 10 to 12 years. Now, I don't think it's any different. 11, 12, 13 kind of gave us a little bit of a head fake. That was kind of the drought, if you will. It feels to us like that the cycle is still very relevant today, as it has been through history. The price cycle. This is a little hard to look at, but I think you can make it out when you look at cattle prices on the green line, cow inventory on the blue, and harvest numbers on the red. I think where we're at is right in here to this, at the end of the exhaustion stage, if you will. We're feeling pretty euphoric there when cattle prices would hit their peak in the fall of 2014, right? I mean, everything was pretty good. The thing that really drives these markets is they continue to have long tails. You see the cow inventory, even after prices start to go down, and they've come down really, really fast in the past few years, they tend to have long tails because the cow inventory is still growing. You as a producer, if you were making $5,000, $6,000 a head back in 14 when you were selling calves, and all of a sudden you get to 16 and you're maybe just making $100 a head, how do you maintain your lifestyle? I went from making, let's just say it was $500 a head to $100 a head. Well, you run more cows, right? You expand if you're able. If Mother Nature will allow it, you expand your numbers because I was making 5, now I'm making 100, so I need more hundreds. So you make more cows. That's the reason the cow inventory continues to go up. Even when cow numbers can start to go down, when it finally comes to the point where there are people that aren't making enough money that they're liquidating their cow herd, the numbers continue to go up on the harvest numbers because we're killing the cows. Again, a really long tail, a long time before prices really fully start to recover. We think that, the normal cycle would say in the year 2020. It's not all doom and gloom between now and then because I think we've seen the bulk of the decline of prices. Doesn't mean that we can't have lower lows. We fully think that's going to happen over the next couple of years. But the bulk of the price decline should be behind us. The challenge is, for you as cow-calf producers, is can you survive the storm? margins are going to get pretty thin. That's what we need to guard against. This is a cycle of market emotions, okay? If you look over here to the optimism, excitement, thrill, euphoria, that's that whole ramp-up stage. And that euphoric state was kind of there in 14. I think we would all agree, and somebody might come up here and slap me for saying this, because no cattle producer wants somebody to say the cattle prices got too high. They got too high. We knew it wasn't sustainable. I'm happy for everybody that profited from it, but you go up so fast, you come down, and it's kind of like a sugar high. You go up, and all of a sudden you crash, and it comes tumbling down, doesn't it? Feel great about this market when it's going up. All of a sudden, the market starts coming down, and you're just like, it's a temporary setback. The market's going to come back. We went through a lot of this. People didn't believe that the market was going to come down, and I'm not patting myself on the back, but, and I hate to say this, unfortunately, what I kind of told you all last year at this event came true, only worse. Prices got worse than we projected. And so, when you look at this and you say to yourself, well, it's a temporary setback. I'm a long-term, I'm in the cow business. You're also a market risk taker all the time. So pretty soon there was a lot of panic and depression. Maybe this market isn't for me. Maybe the cow business isn't for me. And unfortunately, the least efficient producers won't survive this. I hope that's none of you. I don't think it will be, because you come to events like this. The ones that we're worried about are the ones that they're populators, if you will. They're not necessarily concerned about improving cattle, if you will. They're not necessarily concerned about tight calving seasons, weaning weights, genetics, quality of beef. I would assume that the majority of you in this room, since you paid to come here, would be interested in all of those things. We knew that in 2014, early to 2015, there was a point of maximum financial risk in this business. Everybody knew that, and these prices are getting really high. Can they sustain this? I don't know if we're there yet. I don't know if it's this year or next year, but there will be a point of maximum financial opportunity in these markets. A time frame when you'll want to go out there and expand your herd. It's almost the Warren Buffett effect in the cattle business. You do the opposite of what everybody else is doing. If everybody else is expanding, you're selling. If everybody else is selling, you're buying. You're trying to buy them at the lows. You can ride the price wave back up. Again, I don't think it's going to recover this year or next year, but we're getting close to a bottom in this market. By 2020, you would assume that we're close. We want to probably expand our cow herd at that time frame, because that's when we can buy them cheap. The one thing that I would say is that all commodity prices generally revert back towards the cost of production. A good example of that is the corn market and the crude oil market. There's a lot of cash rents out there from corn farmers in the Corn Belt that aren't sustainable today. There's a lot of land up there that sold for $12,000, $15,000 an acre that, how do you justify it with $3.50 corn? There's a lot of crude oil people out there, developers that, when crude got so cheap, all of a sudden they couldn't make it. The least inefficient ones. The beef business is no different. When you look at live cattle, 45% decline from the highs to 98. We sold cattle at 98, live cattle at 98 last October. Feeder cattle, 51% decline. If I had a cow-calf one up here, it's no different. Cow-calf producers obviously have a break-even, an average break-even as well. We think it's in that 140 area for calf prices. Where are you all at? I think that's something you got to ask yourself. What's my cow cost and what's my break-even on my calves? What do I need to receive? We know that U.S. red meat poultry production is increasing. Every segment is increasing. It will be the largest growth in a 4-year span from 2015 to 18 since 1995, more than 9.5 billion pounds, which makes exports a big part of this business, doesn't it? I'm all one for a balanced diet. My family tells me I eat too much beef. I think everybody ought to have a half a beef, a half a hog, and a half a chicken in your freezer. That's about all you need. We got to get rid of it somehow because it's all increasing. We know that exports are going to increase. We've dialed that in. We've got about a 7% beef export increase going forward, but it emphasizes the need for these expanded markets. The global implications today are bigger than they've ever been in history. We know that with a new administration and those types of things, and TPP and NAFTA, and the potential for China opening up, these are the elephants in the room, if you will. All these types of things are things that we're looking at, and we say we have to look at this and try to find out what's going to happen. Beef imports and exports. We feel like that we'll be close to a net exporting country this year. Australia obviously sending us less imports in 16 and obviously in 17 as well. Offsetting each other. Imports down 7, exports up 7. Close to a net export country. Per capita meat consumption. That was a wreck in 15. When per capita meat supplies go up nearly 10 pounds per person, you know that prices are going to get wounded pretty good. That's just too big of a jump in 1 year to consume. Did everybody in this room eat 10 pounds more protein in 15? Well, we can get rid of it at a price, right? I mean, we're not going to dump the meat in the ocean. But who suffers the brunt of that blow is the producers. So again, I mentioned the elephant in the room. What is it? We all talk about, China's opened up to the U.S. beef how many times now since 2003 when they banned it? So many times that when they say we're open, last September when China said we're open, nobody believed it. They didn't give us any rules. What kind of product are you going to accept? You have to assume that it's going to be age and source verification mandatory. You have to assume that it's probably non-implant, non-growth promoting, but we don't know. So the elephant in the room is this. If we could ship 200 million pounds of beef to China this year, that's a game changer, isn't it? That's something that really influences markets to the positive. On the negative side of that, I think overall this administration is going to get better trade deals that are more fair. But it's a timing thing. We're in a stage of production right now where we continue to increase all protein production, yet the TPP and the NAFTA deal, that's a game changer to the negative side. So we kind of got this scale that we're trying to balance and say, which way is it going to tilt? Positive way, where prices are better, or the negative way, where prices are worse? That's the challenge. We don't know for sure right now. It's all about leverage too, and I talked about leverage last year. And I have just the last 3 years, 14, 15, and 16, price comparison up here with regard to the beef cutout, fed steer, feeder cattle, calves, and utility cow prices. Those changes, when you look at it from a percentage change, who had the most leverage in the business? Packers, didn't they? When you increase production and you decrease capacity, they're automatically going to get more leverage. Who had the least amount of leverage? I'll preface that. Who had the most leverage in 2013 and 14? Cow-calf producers. You had a commodity that there wasn't enough of. You were producing it. All of a sudden, through the most rapid expansion in history, we've got more than we can consume right now. We're producing beef, pork, and poultry more than we can get rid of it. So who had the most leverage to lose? I term this, and I say this in a kind of a jokingly way, but the cattle business is a socialist business. They just redistribute the wealth. If one segment's making too much money and another segment isn't, well, you got to balance the scale. If the packer's losing money and the cow-calf producer's making it, we got to take some away from the cow-calf producer. You can't get them too rich. It really is a socialist type of approach to this business. And so, when we look at the industry profitability, and we look at in 2013 and 14, the cow-calf, the green portion of this, they had the most money to give up. When you looked at it in 2014, everybody was making money. I mean, that was kind of the utopia of the past century, if you will. Every segment of production was making money, similar somewhat to what it is today, with the exception of cow-calf producers. You know, they haven't really had a lot of calves to sell since last fall. They could probably be profitable if they had anything to sell. But the other segments are all profitable right now. How long can we maintain that? Slaughter, up 1.5 million head last year, up what we assume is going to be somewhere from 750 to 1 million head again this year. When you look at that and say, you got to step back for a second. That is a tremendous amount of cattle. That is a tremendous amount of beef. Where's it going to go? Export business is really important, isn't it? We look at this in terms of fed plant utilization. We're maxed out. That's the bottom line. This is what concerns CattleFax, and this is what has us scratching our head every day saying to ourselves, how much leverage do we as cattle producers have to give up to the packer in order to get through the cattle? In other words, if China opened up and said, we're going to take 200 million pounds of beef this year, and we say, great. That's a game changer to the market, but if you can't get the cattle dead, it doesn't really matter how big your export market is, does it? The beef packing facilities are in competition with 3 new pork facilities that are coming on board and 2 new poultry facilities that are coming on board this year. Folks, you all know what kind of job that is. That's not easy labor. We're fighting for a workforce that's declining, okay? We're maxed out when we get to with regard to packing capacity. And the reason why is because the packing segments have become very responsive to when they were unprofitable. In the mid-2000s, Tyson closed in West Point, Nebraska, and Boise, Idaho. Tyson closed Emporia, Kansas in 2008. Cargill closed Plainview in 2013. That was a big hit to the industry. They killed an enormous amount of cattle. National closed Raleigh, California. Tyson again closed Denison, Iowa. PM Beef in the Corn Belt area. When they lose money, they shut it down. So what happens? We got more supply today. Packers got the leverage. They had record profits of $98 a head in 2016. They've never made that much money per head on an annual basis in history. I tell you who's got the leverage. This is concerning to us. This is based on a 40-hour kill week, the black line up there, about 465,000 through the first half of the year. That says week 14. I pulled the wrong slide. This is actually week 17. But the point is valid, that based on a 40-hour week, we feel like that the daily kill for steer and heifer slaughter is about 93,000 head per day. Okay? In order to get through the supply that we have projected, we're going to have to increase that daily kill to 95,000 a day. We're going to have to kill, instead of Saturday's 30,000, more like 40 to 50,000. That taxes your labor force. The union, not sure it starts with line, you can only work so many hours. We think the second half of the year that some of these cow plants will start processing some fed cattle. That'll give us a little bit of relief. Now, we've pulled a lot of cattle forward. The market's been good enough, cattle feeders have been profitable enough that we've pulled some of those May cattle into April. We pulled some of those April cattle into March. In other words, we're turning over the supply quicker at lighter weights. Carcass weights are down. Consequently, so is grade and yield, because we are pulling the cattle so quickly. And they're still coming. We're still expanding the herd. Percent of heifers on replacements, USDA said they're up. We look at the percent of heifers as percent of placements into feed yards, they're up, are down. We look at the heifer percentage as a percent of the fed kill. Again, very near long-term expansion numbers. Beef cow inventory up 1 million head in 17. We're projecting up another basically 800,000 head in 18 before we kind of flatten it out. We talked about the cattle cycle and those peak numbers. Where are the cows coming? Where has the increase in expansion come? This is the Southern Plains area, the big number, over 1 million head since 2014. We compared it to 2014 because that was the low in cow numbers, the lowest cow numbers that we've seen in 50 years. Texas is up over 500,000. This is the Southern Plains areas, Oklahoma, Missouri, Kansas, Nebraska. That's where the expansion has occurred. Obviously, during the drought, those are the cow states. These are major cow states, and that's where we lost the most number of cows during the drought period. This is comparing to 2006, prior to the recession, if you will. We're just the red line is the Southern Plains again. You can see where we have expansion capabilities to still occur. Southern Plains is down 780,000 head still. A lot of this is based on Mother Nature. Mother Nature dictates when we're going to expand the cow herd, but also so does profit, okay? Within this, we look at the correlation between calf prices and bred cow prices. They should be very tightly correlated, shouldn't they? The market was so profitable, though, during that 13, 14, 15 time frame that this ratio is getting a little out of whack, okay? 25-year average, number of 550-pound steer calves to pay for a bred cow. These are running age type cows, okay? These aren't heifers, these aren't aged cows. I'd say these are 3 to 7 year old cows for the most part is what we've quoted in this. You can see how during these expansion time frames, people tend to pay more for these females than they probably should or could justify. When you look at least our projection to the market that says we feel like that there's potential for lower calf prices in the next couple years. Do you want to go out there and pay too much for bred females that are this much out of balance? Are you a speculator from day one when you do this? Dang right. So how much is a bred cow worth? You kind of have to have an idea of what calf prices are going to do, don't you? You know, if calf prices were 140, if that's an idea, you know, it's down 42% from the highs in 2014. That kind of tells you what the data, what history says bred females are worth. It's not what I'm valuing them at. It's what the data says they're worth. Okay? Be careful. If you're going to expand, and I know the weather's been tremendous down here from what I understand this spring, and if you're going to expand, you have to do it at a cost. There's a cost to expansion. The same when you're looking at bulls. This is Angus bull data that we have. You know, it's going to be similar across breeds, very similar correlation. What this is 5 calves, steers and heifers, just averaged, the Califax price. Steer and heifer calves weighing 550 pounds, the average price times 5. What this says is that most people, or historically, the data would say bulls are worth 5 calves. Average price of 5 calves. Average. We know there's bulls that are going to bring more. We know there's bulls that are going to bring less. It's very indicative to the data. When you look at 2013, very similar prices. The market was going up the second half of the year. When you look at 2014, well, all the sales, majority of the bulls are selling in the spring, and it was a bull market. Calf prices went up all year long. So the price of the market of calves outpaced bulls. When you get to 15, you know, the market's kind of turning over. Those are the peak prices in terms of bulls, and calf values are coming down. We think that 16 is very indicative of a market that was still really, really strong in the spring. You know, people probably paying more for bulls than was justifiable, particularly in light of what calf prices did. We think that's going to stabilize going forward. But you have to take a whole operation view. How much are you paying for bulls? Now, well, I understand our cow-calf survey data would indicate that the bulls that brought more money weaned heavier calves, those types of things. I understand that. I'm saying average prices. You have to take a look at the cost of expansion, what you're paying for bulls. This is indicative of what happened last year when we got to October time frame, because this is just looking at the calf to feeder cattle ratio, price ratio, if you will. What this is implying is that, say, kind of a 10 to 12% premium, calf prices should be 10 to 12% premium to feeder cattle prices in the fall of the year. This is implying that calves will be worth mid-50s this fall. That's pretty optimistic, certainly much better than it was last year. We averaged 127 in the month of October. I think most people would kind of take this. If you could get that, if you could forward contract your calves today in the mid-150s, what do you think? Would you be a taker? Are you more optimistic than that? Money in the hand, bird in the hand worth two in the bush, that type of a thing. We have to think about that. If you had the opportunity to forward contract your calves today for a profit, would you do it? Many of you are going to have this opportunity. I think these summer videos could be pretty good. I think you are better off forward contracting calves this year. Saw what happened last fall. Horrible. This is, again, the average 550-pound steer price is a decline from the first half of the year high to the second half low, okay? We had a high near 170 last week. Your spring demand is always the biggest. Green grass fever, if you will. Spring high at 170 would say calves are worth the upper 140s, not too far from the last chart I showed in the mid-150s. Upper 140s to mid-150s is kind of what the market is implying today calves will be worth this fall. You see that big red arrow on there? You see the percent decline, the record decline over 35% the last 2 years? What if that happens? This is what we're trying to avoid, okay? This is what we're trying to guard against. This is what we're trying to manage risk against. We manage risk in every other aspect of our lives. Life insurance, health insurance, vehicle insurance, fire insurance. You have a lot at risk in this cattle market, don't you? Through the LRP program, whether it be through the futures market, whether it be through forward contracts, we need to try to mitigate the risk that this market has. We know it has potential to drop over 35% because it's done it. Never done it before, but we've got to guard against that. One of the reasons why the market was so sorry last fall is because I'm looking at, if you just compare the green and the blue line, the green line is the index of expansion years, when the cow herd is expanding, versus just a normal seasonal index. We're in expansion mode. What happens to the fed market? The lows come later in the year, don't they? That September, October time frame. Our lows last year were in October at 98. The market declined way more than we thought. That's the thing with these markets today is the percentage changes from the lows to the highs and the highs to the lows are unprecedented. We've never seen these types of moves in the markets before. And that's why it makes it so imperative to manage risk in this environment. Quite frankly, folks, we don't know if the Fed market, if the highs were last week at 131 and some change for a U.S. average in the Fed cattle market, we don't know if it's going to drop 10% or 40%. We just don't. And nobody does. Because of the global implications on these markets, they move so fast. We think the Fed market's got good support at 110 for a low this year. Timing-wise, we would expect a later low. If we go through the 110 area, we've got risk to the 98 area. If we have a 30% break, we've got risk to the low 90s area. You see where I'm coming from here? We've got to be able to be risk managers and not market takers. if you will, at the whatever time frame. Again, I wanted to show this because those of you that retained ownership on your calf crop last year, whatever form you could, it paid you to do so. I'm not naive enough to think that everybody in this room has the ability to do all of these things, but pick out the ones that your operation can do. And the reason why is because you don't want to be a market taker in October when the lows are at 127, do you? No. If you have the feed, if you have the labor, if you have the ability, look at one of these other ways of trying to profit or increase the value of your calf. These are something that we came up with. We have these for the fed cattle market too. And the first one for the fed cattle market is, are the cattle that you're selling currently profitable? Second is, what is the swap? Are you able to purchase calves back with a higher or lower break even than what you have today? And what is the basis relationship? If you're dealing with a discount board, you're able to buy calves cheaper because everybody's breaking them even against a lower fed cattle value perceived. The same thing for cow, calf, and stocker operators. I intentionally designed these so that you don't have to think very hard or project anything. I could have put, what's the value of corn going to do? Well, you have to project, right? If you look at these, I think you can say, are the segments after me profitable? Are the purchasers of my cattle profitable? Have they been profitable on their last turn? Winter grazing operations, summer grass operations. People that are going to be buying your calf crop, feed yards, are they profitable? If not, that makes it a little tougher sell, doesn't it? Are cattle and competing protein numbers expanding or contracting? Pretty easy to decide. We know that all of these are expanding. And are the deferred futures at a premium or a discount basis, if you will? So let's look. Just in 2016, cow-calf producers were still profitable on average. Stocker, feedlot, losing money. But look at the last 2 years. They didn't make any money. Summer operators, marginal profit this year. Again, depending on when you're buying them and what the futures are implying today. But look at the past 2 years. No money. When we look at the fed cattle market, now in 17 they've made money thus far, every month in this year. They went 2 years without making a dime. The purchases of your cattle. Are cattle and competing protein numbers expanding or contracting? We went through this. The beef cow inventory is going to grow, at least until 2020. Commercial beef production continuing to go up. Pork and poultry production, again, continuing to go up. I know I'm going through some of these fast, but this is the bottom line. That for 2017, each protein is going to increase about 1 billion pounds of production. Again, one of the kind of elephants in the room, these competing meats, packing capacity situation, export potential, potential for a lack of exports. All these things are the questions. Are deferred futures at a premium or discount? We've had the widest basis levels in the live cattle futures that we've ever had in history. Uncharted territory. Number one, it tells me the contract's broken. It's not indicative of what the market is producing today. The contract specs say 55% choice or better. The cattle are grading 75, 80% choice or better today. That's not indicative of what we're producing. So who wants to be long the market? The funds are long the market, but who wants to get delivered on, because you know you can get heifers delivered on you. You know, if you're long the market, you can get everything can be delivered on you because it'll all qualify. This is one of the things that hurts you as a cow, calf, or stocker operator. When the live cattle futures are at such a significant discount, the purchases of your cattle are running a break even against that market. Now, the futures market prices, I think, are more indicative of supply versus price at this point. The market's saying, prove it to us that you can move all of this protein. Thus far, we've done it. Export market's been phenomenal. Demand domestically has been phenomenal. Seasonality of these calf prices. Calf prices have gone up. They haven't gone up with near the trajectory that they typically do. But what we're trying to guard against is those 2016 prices, and even in seasonal years, the lows of the market in the fall. Trying to forward contract those calves so we're not selling in that spot market would be the best thing. Feeder cattle prices, very seasonal up to this point. If you're a stocker operator and you got cattle coming off grass in the late summer, early fall, typically can afford to be less aggressive managing risk, knowing the seasonality of the market. 80% of the time, 8 out of 10 years, this is what will develop. I'm just playing the odds, okay? And it's telling me that I still need to manage risk. I'm not going to argue with anybody that manages risk and hedges the board or buys a put and sells a call or those types of things based on profit. With every set of cattle that you purchase, everybody has to have a reasonable expectation for profit. It's a lot easier to hedge a $50 a head profit than it was a couple of years ago, a $200 a head loss. When do you need to hedge to quit from turning that 200 head loss into 400? When you're losing 200. When do you hedge when you're making 50 versus losing 100? Markets can change so quickly. Everybody gets greedy. Everybody wants more, don't they? Utility cow prices, very similar to the seasonality of calves. Again, take a whole operation view and know these seasonals. Do we want to be selling cows in November? When most people sell cows, that's why we have the lowest prices, isn't it? This is what I mean. What makes markets move? The two words up here, greed and fear. This is September feeder cattle of 16, okay? Now how many, when I talk about people that are losing $200 a head and they say, well, the market's going to come back, and all of a sudden they're losing $400 or $500 a head, this is why. When the market's up there in the mid-160s, everybody's saying, well, still early in the year, you know, it's this December. I don't know if I want to do that or not. You get to May or March, and the price is at 162, and they say, well, I got some cattle, but, I think that market can go back higher. All of a sudden, it goes to 154. And what are they saying? Well, when it gets back to 162, I'm going to do something. Market goes down to 150. What are they saying? Well, when it gets back to 154, you see where I'm coming from here, right? We're chasing the market. Instead of taking what the market gives us at a reasonable expectation for profit, we get greedy. It's human nature. We all want more. We don't want to leave money sitting on the table. But if you're diligent about managing risk, you're okay leaving money on the table because you're going to save yourself from the wrecks that could potentially come that have come the past 2 years, right? Average cow-calf profit and loss. These are just cash costs only, okay? What you'll notice down here at the bottom is that average return producers, based on our cow-calf survey data, have a calf break-even of about $1.40. You all have to know this number. I'm going to challenge each and every one of you to know what your cow cost is and know what you need to get in return on your calf crop before you're not making any money. Because I think we're getting close to that. We don't want to do that. We've got to develop strategies to guard against just breaking even. Nobody wants to just break even. That's no fun. You're not doing this for the practice. The difference between high return producers and low return producers is that the high return producers back since 1980 very seldom lost any money. Now, they didn't make a lot sometimes. The difference is that if you go from 1980 to 2000, this shows you that the yellow bars say this is kind of a break-even business. That wasn't sustainable. We couldn't continue to do things with that thin of margins. Low return producers very seldom made money during that time span. High return producers don't cheat or don't compromise when it comes to animal health, nutrition, and genetics. Those three things all lead to the most economically important trait in the business, and that is fertility. We know that if you can't get them bred, obviously you can't have a calf. Marketing is the other thing that separates the high return producers from the average or low. This is data from our cow-calf survey, okay? This is over 1,500 responses. Pretty good sample size, I would say. Average herd size is 471. The cash cow cost actually went down. And now, don't compare yourself against this because these are U.S. average numbers. They're different regionally, okay? So, you know, if your numbers differ significantly from these, great, but don't put too much weight into it. If your number's below this number, kind of take it with a little bit of grain of salt. Calf revenue obviously down. Average price per hundredweight down significantly. I think the biggest thing is that the weaning weights were up 2 pounds compared to 2015. You know, a lot of that is influenced by weather and winter and those types of things. But the biggest one is that 90% plan to expand or keep their cow herd steady in 17 and 92% in 18. That tells you that expansion isn't really slowing down, that numbers aren't going down, that the challenges are still ahead of us with regard to price for calves unless we have some of those game-changing type things that are involved in the market, unless China opens up, for instance. Now, here's some regional prices, and I think these are relative to you all. You know, in the yellow section down here, cow costs in the upper fives. I think that's a pretty relative number to you all because majority of that region is going to encompass this. So that's important. Calf crop percent sorted by returns. The higher return producers have a bigger calf crop. They have a tighter calving season. What that does is they have more calves in a quicker period of time, so they have more calves to sell at a heavier weight. That's why they're high return. 0 to 60-day calving seasons is what the majority of the high return producers were in. Weaning weight sorted by returns. Again, tighter calving season at heavier weights. The stair steps to profitability. When you get into the environment that the market is in today, when margins are going to be thin for a lot of these segments and could be for a few years, adding value to your calf crop is almost imperative, okay? But you can't necessarily do it if it's costing you more to do than you're going to get in return. For instance, weaning calves. What we've seen over the past several years is they're at about a $6 to $7 per hundredweight premium. The longer you retain ownership of them, the more risk you incur. Death loss. Now, the morbidity and mortality rates, the longer you own them, is tough. You have to weigh this out. You have to, more importantly, go for the performance history that is at the top of this list. If you have the performance history, if you've weaned your calves, and you've done it the right way, because so many of these feed yards today, they don't necessarily care if they're weaned, they care how they're weaned, okay? They want their own protocol followed. Even if they buy weaned calves, they still put them through their protocol the majority of the time. That's important. If you've got calves that have performed and you've got buyers that are returning every year, that performance history is worth a lot. If you're weaning your calves, if you've got them age and source verified, again, if the China deal happens, you got to believe that's going to need to be there. These breed and certified management programs, whatever you can do to add value is great, but don't go out there and just expect to get paid for it. Don't raise natural calves or natural feeder cattle and expect somebody to just come and say, oh yeah, I'll give you $10 a hundredweight premium for those. Kind of got to check out the program beforehand. I did want to go through this. Dr. Art Douglas, the Cattlefax meteorologist that works for us, kind of gone through the temperature on the left and the precip on the right for the summer months, okay? And it's going to be hot in June, really hot, above normal. July, obviously, kind of near normal to warmer, and then August, kind of near normal. The biggest one is the precipitation on here. Certainly looks pretty good for the summer time frame, doesn't it? And this is just kind of a combination slide for the summer temperature and summer precipitation for this part of the world. If there's anything to give you some optimism, this is certainly one of them, particularly the devastation that this area has gone through. I want you all to know that there was a heck of a lot of prayers out there for everybody that endured that. CattleFax, we'd like you to be a member of CattleFax if you're not already. If you like the information that we come up with, I think we can help you out. We have our weekly update that comes out, a monthly publication called Trends that is a cow-calf publication. We have our app, our website, obviously, 2 long-term outlooks, and obviously weekly audios and things of that nature. If you don't have our app, I would encourage you to get it. Our new app and website has been very well taken in by the industry, and it's very popular out there. So I would say this, one of the things that maybe some of y'all have heard this story before. I applaud you all for coming to this event. I know you've paid to come here. This is a tremendous lineup of speakers, excluding myself. This is a tremendous lineup of speakers, one of the best conferences in the country. Maybe y'all have heard this story before, but there was I don't know if I got my message across to anyone. I hopefully that at least some of you have taken some of the information I've presented today and will take it home and use it. But there was a beach that some strange phenomenon had occurred, washed millions of starfish on the beach. Millions of them. There was a guy on vacation that was in one of these high-rise hotels just looking at all these starfish, and he saw a little boy down there on the beach just going as fast as he could, picking up these starfish and throwing them back in the ocean. I mean, obviously he was inundated with starfish, but he just kept throwing both hands, throwing the fish in the ocean. The man's kind of looking down there, and he goes down there, and he says to the young man, he says, "What are you doing?" He says, "I'm throwing these starfish back in the ocean." He says, "Do you see how many starfish are here? Don't you understand that what you're doing, it doesn't matter?" The little boy picked up a starfish, and he said, "It matters to this one." And that's the way I feel about all of you.